Okay, good afternoon, everybody, and welcome to our Zoom and Facebook webinar viewers. And thank you for joining Bellboy's live webinar on understanding your schemes' monthly management accounts. My name is Chantal van Heerden, and I'm the Managing Director of Bellboy. And I'm joined today by my fellow director, Shannon Moore-Barnes, and our presenter, Jason Wallace. Bellboy has been a leader in community scheme property management since 1996. And I invite you to please visit our website on www.bellboy.co.za and follow us on Twitter and on Facebook. In addition to community scheme property management, Bellboy also offers accounting services for small to medium-sized businesses, as well as staff payroll services. We also offer property rental and sales services. Bellboy will be hosting a series of webinars over the next 3 Thursdays, kickstarting it today, wherein we unpack the financial documentation provided to governing body members. We trust that these webinars will assist our governing body members to better understand the financial documentation that are so essential to the effective financial management of your community schemes. Now, it gives me really great pleasure to formally introduce our presenter, our very own Jason Wallace, who will be presenting today's topic on namely understanding monthly management accounts. Jason Wallace joined Bellboy in 2012 and is Bellboy's operational and financial manager. Jason kickstarted his career teaching computers, mathematics, and accounts to high school students before going into the private sector, where for the last 17 years, he has primarily been in the financial division of community scheme management companies. Jason is currently studying towards his BCom degree in financial accounting and is now in his final year. We are extremely proud of him. Jason, just some cyber housekeeping before we kickstart today's webinar. If you have any questions during the presentation, please type your question into the question box in your Zoom control panel at the bottom of your screen. I will put as many questions as possible as time permits to our speaker, Jason, at the end of the training session. Any questions we are unable to answer during this webinar, we'll respond to them following this webinar. Also, we will be running some polls. We'll be conducting some polls during the webinar. Please participate in these polls. This will assist us in better understanding our audience. Now, with any further ado, I'll turn to our presenter, Jason Wallace. Thank you, Jason.
Thanks, Chantal. I'm just going to start the slideshow here. Okay, great. Welcome, everybody. As Chantal said, today we're going to be going through the monthly management accounts that we send through to the governing body members of each scheme every month. We've drawn up a PowerPoint presentation which we'll run through with you now. Okay, so the topics that we're going to look at, we're going to look at the cover sheet, what information's on there, income and expenditure sheet, the statement of financial position, the trial balance, the cash flow statement, and then the bank accounts and the reconciliations, the age analysis, and the invoices at the end. So those are all the documents that are included in the monthly management pack that we send through to you. Okay, so just to start off, before we actually look at a set of management accounts, what is management accounting? So management accounting definition is accounting for planning, control, and evaluation. The first element of management accounting is monitoring and controlling the present. So understanding where you are currently. So the whole purpose of the packs that we send through to you is showing you where you are currently so you can control the present in effect. And then evaluating the past and then planning for the future. Management accounting data has value if it improves management decisions and the decisions trustees and governing body members can make with regards to can invoices be paid, when they can be paid, what projects can be done, etc. But we'll touch on some of those elements as we're going through. Okay, great. So the very first thing then is your cover page. In your cover page, I've just zoomed in a little there so you can see it. So we've got the scheme. This is not an actual scheme. It's United Villas as a test scheme. So don't worry, we're not going to be broadcasting any of your scheme's financial information in the presentation today. Okay, so the scheme name will appear, monthly management accounts. This is for the period ending. And then in this case, the management accounts is for the period ending the 31st of January 20XXX. And then the financial year end of the scheme is also noted. And the financial year end of the scheme that we're looking at today, their financial year end is February. These management accounts are drawn up to the end of January. So in effect, there's 1 month still to go for this scheme in their financial year. Okay, so just some side notes here. As of the 7th of October 2016, with the introduction of the Sectional Title Schemes Management Act, all newly established body corporates have a financial year end, which runs from the first day of October to the last day of September. Existing body corporates continue with their current year ends, and members by an ordinary resolution may change the financial year end of the body corporate. Okay, and then just a snip again before we look at the income and expenditure sheet. So just a snip from the regulations. So it says a body corporate must keep proper books of accounts that, 1, record its income and expenditure, assets and liabilities. 2, disclose all amounts received from members by the body corporate for any managing agent or other service provider acting on its behalf. 3, include individual accounts for each member. And finally, contain all other information necessary to allow members to assess the body corporate's financial situation and their financial situation in regards to the body corporate. Okay, so that's the purpose of the accounts that we're sending out to you. So when we get to the end, hopefully you can see that that can be achieved. Right, okay, so then we get to the first page of data, or the first page with real information on it. So we're looking here, this is the statement of income and expenditure. Just this poll, sorry, it's come up there. Okay, so the statement of income and expenditure. At the top left-hand corner, we'll start there and we'll zoom in and we'll look at each of these sections. So if I just zoom into the top left-hand corner here, it should be on the next slide. Here we go. Okay, so in the statement of income and expenditure, on the left here, you can see it says actual, then it's got a budget, and then it's got a variance column. So that actual column is the sum of all actual expenditure in the current financial year, year to date. So in this case with United Villas, we're 11 months in, so that actual will be 11 months of actual income. So I'm looking at that first line, common property unregistered extension, 9,163. So that's the amount that has actually been charged to owners for unregistered extension contributions. So, and then you've got the budgeted column. The amount that was budgeted to be charged out to owners was 9,163. And then the variance column, if I just bring a pen over here, the variance column shows that there's no variance. In terms of unit levies and unregistered extension levies, the amount that the scheme normally budget for is the amount that we as managing agents will charge out. So you wouldn't expect there to be a variance between the amount that was in the budget and the amount that's actually been spent. There are exceptions to that, which we'll look at shortly. Okay, let's just go to the next slide here so we can. Okay, so like I was saying, with regards to levies and unregistered extensions, for example, the amount that's budgeted is the amount that we will raise. The exception to that is phased development schemes. So we might budget, or a scheme will have, at the time the budget was drawn up, they had 60 units, the budget's approved, it goes through, and more units register as time goes on. So in that scenario, you might have a situation where the actual is higher than the budget. But that's rare. Most cases, there won't actually be a variance. Okay, then we've got arrear levy interest. So this section here that we're looking at, which is the income. So this is all the income of the scheme. So far, we've got arrear levy interest. This is not a budgeted item. because if you look here, it says penalties, interest on arrears, interest on investment should not be used to subsidize levies. So not in the budget, and therefore actual will equal to the variance. So penalties, interest on arrear levy accounts, interest on investments and current accounts, all those things, whilst it's an income and you might anticipate as a scheme, we're going to get, you know, interest from owners who are in default, or we're going to get interest from our investment account, which is earning, you know, interest. One shouldn't include that in their budget when they're doing it, but we are going to have a specific session dealing with budgets and how to prepare budgets and what we look for and what we put in and why we put in certain things. But just as an aside here then, because it's not a budgeted cost center, the actual, so the amount that's received for arrear levy interest and interest on current account and penalties will actually be the variance. So in this case, the scheme has received £2.92 in arrear levy interest year to date. Nothing was budgeted for, so there's a variance of £2.92. And then similarly with interest, you've got interest on the current and investment account. Total interest earned by the scheme year to date is £3,161.61. It's not a budgeted item, so the variance is £3,161.61. Okay, and then the scheme is a recoverable scheme, so they recover water. They recover water from owners. So in this case, then they've got an income from the recoveries of water, sewage, and availability from owners, and the year to date for that is 20,669 as an actual expenditure. Okay, so let's just go through the notes here on the right. Levies budgeted, so this top left-hand corner where we show how much has actually been received for levies and then how much was budgeted for. Levies budgeted to be raised have been raised. This is not an indication that levies are paid. So in terms of accounting practice, when in your income and expenditure, we will raise the levies that we're meant to in terms of the budget. This does not indicate that they've all been paid. You would still have to look at your trade debtors to see which owners have paid and which owners haven't paid yet. And this is just showing that we've raised the levies. It's not an indication that levies have been paid. Okay, then we've got this note which we've gone through, which is regarding the penalties. Major variances should be checked. So as trustees, when you get these management accounts, it's really important for you to go through and have a look and compare the actuals to the budget, and then it gives you a variance. So you've got a variance column here, and it shows you and actually highlights in red any cost centers which have been overspent. So go to those cost centers and see if there's any which have a major variance, and see why is there a major variance. It's usually things like plumbing or repairs and maintenance, general things which come up during the year which you didn't anticipate. So usually it's just a matter of under budgeting in that cost center for but it's good for you to know and check. If you're not sure why there's a major variance, in your trustees minutes for those schemes who are on comprehensive management, when you get your trustees minutes, in that section, the property portfolio managers will discuss with you the major variances. They will tell you which invoices they were for, when they were, during which period, which month they were spent, etc. So you can understand them. If you're in a scheme that's unlimited management, and you want to know what those major variances are, speak to your property portfolio manager and they can pull up the invoices for that period, and you can see what was spent. Okay, great. And then finally, here at the bottom, so in terms of the budget, so in this case, I'm just going to see if I can go in a bit. Okay, so in this case here, we had a total budgeted income, 93,643. The budget has been captured, and the total expenses in the budget is 93,643. So there shouldn't be a difference between your income and your expenditure. So if you look here on the right, the note just says community schemes budgeted income should equal to the budgeted expense. There are exceptions. The exception is A, an intentional surplus to clear negative general fund from previous years. So if the scheme has a negative general fund, I'll explain what a general fund is in a second. If the scheme have a negative general fund, they can budget to bring in more income than they're going to be spending. And the other exception to it is a loss due to a cap on levy increases. So in terms of the Sectional Title Schemes Management Act, trustees can implement an interim budget up until the general meeting is held. And the maximum percentage that the trustees can increase the budget by is 10%. So you might find the scheme have expenses which would mean they actually need to put into place a 20 or a 30% increase, but the trustees are limited to increasing the budget to 10% until they get to the AGM. So they'll increase it up to that maximum of 10. They'll come to the AGM and say, this is what we predict that we're going to need in terms of income to cover our expenses, which will mean a 20 or 30% increase. And then at that general meeting, a further increase will be put into place. So like I said, 99% of the time, your budgeted income will equal to your budgeted expense, and you won't have a variance at the bottom. But there are exceptions like those two I've just explained now. Okay, and then finally, if there's any amounts which have been brought in from the reserve account to pay for any particular expense, those will also be reflected in here. So if I just go back a slide, or forward a slide, I think, here we go. Okay. So if you look, I've highlighted it in yellow. There is an expense under expenditure. There's a line here which says reserve fund expenditure general. And in the month of November, the amount was 11,822 Rand 50. So that was reserve fund expenditure. We've included it in the income and expenditure as an expense, but the money for it wasn't coming out of the normal levies which were raised in the year. The money to pay for that reserve fund expenditure is coming from reserves. So we bring the money in here at the end in order to pay for that reserve fund expenditure. So in this case, if you're looking at November as a whole, so this scheme had this income here, which is 8,994.61. Total expenses for the year was this amount here. It's 31,212 Rand 66, which means that their loss for that month was 22,218. But 11,922 was brought in from reserve. So the loss wasn't as high as the 22,000. They actually only made a loss then of 10,395 Rand 55. Because that 11,000 was brought in from the reserve fund to pay for that expenditure. Okay, I hope that's clear. Okay, another thing as trustees, if you look at this, I've highlighted here water and sewage. So if you go along that line, you can see how much the scheme has been paying for water throughout the year. So in this case, it started off at 1.3 and then it went to 1.2, 1.6. So as a trustee, it's quite useful how these accounts are presented. We actually had our income and expenditure sheet developed for us in order to reflect this way, because we felt it was actually very useful to see the entire year as a whole and to be able to compare, previous months to new months, etc. So Balboy actually got this income and expenditure sheet developed this way specifically for us. And like I said, it's great because you can actually go through and have a look and see what's happened in each of the months. Is there a month where a payment was missing? Is there a month where a double charge was made, etc. So looking at the water line, for example, in the scheme, you can see here it started off with 1,387. And throughout the year, it remained pretty constant. And then suddenly at the end of the year in January here, you can see it's gone up to 2,229. So on the grand scheme of things, that might not look like a lot, but for a scheme that normally pays 1,400, 1,600, to have an increase of 400, that's about 25% increase. That's a big increase. So one could then instantly say, okay, that seems a bit high. Is there a leak? Is there, is it possible that somebody's toilet's running, etc., etc.? And then investigation can go on and happen there. So, so as trustees, go through, have a look at your income and expenditure sheet, compare the months through the year. If you look through here, you can see in this month over here, so this line is for garden maintenance contract. Nothing was paid in that month, but then the double payment was made in this month. And then later on, I think it was in November, the garden service actually didn't come. So they got a credit refunded to them. And they also didn't attend in December. So there was actually no expense. And then in January, they continued as normal. So having the management accounts laid out like this, you can actually go through and see in the month of September, for example, when that 2,000 was paid, if it wasn't laid out like this, you would think, okay, there's a duplicate invoice being paid. But you can clearly see that it was to cover for a missed payment here. There is a question that I often get asked from trustees, which is, why don't we make a provision in these scenarios? So in this case, why didn't we make a provision? We knew that the garden service came out in August. We knew that they cut the lawn. We knew that we were going to owe them 1,020 Rand. So why didn't we make a provision rather than show nothing being paid and then a double payment being made here? So we can make a provision, but our default stance is with management accounts, we want to reflect what happened. So I'll give you an example, say in business accounting. So if you've got a business and you're looking at somebody's management accounts or a business management account, and you see every month there's an expense for wages of 9,300, and it's clear, and it's every single month 9,300 in each of those cost centers. Now, that's fine because that was their expense in that year. But if the accounting is done this way, and for example, it's a company that's struggling, they're not able to meet payroll, they actually, all of their income comes in and then it goes out to pay for wages, whatever the case may be. So you would get months where perhaps the staff weren't actually paid and they're only paid, say, on the 3rd or 4th of the following month. That sort of thing you wouldn't actually be able to tell if you went and made a provision that the wages, okay, the 9,300 was paid and this is for this month, so we made a provision in that month for it. So our default stance is we make provisions for audit fees, tax assessment, and workmen's compensation, and we will make provisions for other cost centers where we are asked to. So if you say, I don't like cash-based accounting, I'd like you to actually make a provision for garden service in each of the months, and then we'll look at the liabilities and the assets in the balance sheet and clear it from there. That's fine, we can do that. So on request, we can do it, but our default stance is we make provisions for audit fees, tax assessment, and workmen's comp, and then the rest will be on request. Okay, great. Finally, on the sheet, the last thing I'd just like to show you. Okay, so let's go on to the interest on current and investment. So this line here. So this income line here is interest on current and investment accounts. So all your interest that the scheme earn in their current account and in their investment account comes into this line here under income. And you'll see there's also a line further down which says reserve fund interest, which is here. And I'll just highlight the amount there. And you see an expense for reserve fund interest. So the reason for this is, if you look at the bottom of your management accounts, it says Sessional Title Schemes Act Regulation 24(3)(c) requires reserve fund interest to be transferred to the reserve fund. Therefore, we can no longer allocate this to other income interest for current and reserves and have journaled to the reserve fund future maintenance. as this is good practice, we're also doing it for homeowners associations. So that's the note which is at the end of your management accounts. I don't know how many of you spotted that note being inserted about 3 years ago when the regs came in. But so in effect, what it's saying is, in terms of the Act, in terms of the Sectional Title Schemes Management Act, so it's only applicable to sectional title schemes. But in terms of the Act, it says interest earned on your investment account should remain or should be accounted for as part of your reserves in order to pay for your future maintenance reserves at the time it comes up. So the idea was, if at the moment you get a quotation to replace windows in 10 years' time, you start putting away those funds. The interest earned on those funds being in the investment account should remain as part of the reserve, so that in 10 years' time, with inflation and prices going up, the amount that you would have saved would actually be what you need to replace those windows. So that's kind of the idea behind that clause in the regulations, is saying interest earned needs to remain in the reserve fund. So why then do we put it into the income and expenditure sheet? Because we could very easily, that interest comes in through the bank account, comes on your investment account statement. We could allocate it directly to reserves, but we then have another issue, and that is a reporting responsibility. So we interest earned on current investment accounts is actually a taxable expense. Is a taxable income. So in terms of SARS, because it's a third-party income, we need to declare how much interest the scheme have earned from investment accounts, from penalties raised against owners, and interest raised against owners. So how much third-party income? Some schemes have, say, cell phone towers on their roof. Some schemes rent out space to companies to use storerooms, etc. So things like that. Any third-party income is taxable. So in terms of SARS, we need to declare that income. So that's why we have to bring the interest earned on the investment account in as an income, and then we take it out as an expense and to the actual reserve fund account to increase the reserve by that amount. Okay, great. Okay, next slide. Okay, at the bottom of your management accounts on your income and expenditure sheet, there's another note. It says, which I was just saying a bit earlier, unless instructed differently, monthly provisions as per budget have been made for the following cost centers: audit fees, accounting fees, and workmen's compensation. Further provisions made on request from the governing body. So that was the note which I was making. So if you look here under audit fees, you can see each month we've made a provision. So that's gone through to the balance sheet to pay the auditor at the end of the year. And the same thing with tax assessment. The scheme is doesn't have workmen's comp, but if your scheme does have workmen's compensation, we do the same thing. We make a provision. Other than that, provisions will be made on request. Okay. Just two notes here then to go through with you. 9C of the regulations say that the trustees, so this is under trustees' responsibilities, the trustees must apply the body corporate's funds in accordance with the budgets approved by members in the general meeting. So there's a responsibility that the budget which is approved by members at the general meeting is what the trustees should apply throughout the year. And then the second 24B in the regulations, it says, provided that the trustees must report to each member on such expenditure as soon as possible after it is made. So this is where urgent repairs and maintenance has been necessary. So it says to repair, maintain, replace any property for which the body corporate is responsible, where there are reasonable grounds to believe that immediate expenditure is necessary. So this is the conditions under which the trustees can spend more than what is in the budget. So it's where there's reasonable grounds to believe that immediate expenditure is necessary. to repair any property for which the body corporate is responsible, where the need for the repair could not have been reasonably foreseen in preparing the maintenance, repair and replacement plan. So unforeseen expenditure. So in terms of the direction though that's given to the trustees have an obligation to spend the budget, or can only spend the budget in terms of what's been approved at the general meeting. So a problem comes in is that you've got a cost center where you've got repairs and maintenance plumbing. So repairs and maintenance plumbing, the owners at the general meeting say, okay, for the year we're going to spend 20,000. We come to June, halfway through the year, and you've already spent 30,000. So that cost center is already in a deficit. And it's been necessary because that plumbing work needed to be done, or that maintenance needed to be done. So, but in terms of the act, what actually needs to happen is the trustees actually need to write to the owners to say, you know, in terms of the general meeting, you gave us a mandate to spend 20,000 on repairing or on plumbing, and we've gone over that, and we've spent more than that, and then, you know, advise them and say it was necessary because there was, you know, repairs that we didn't know that were going to come, or it was more expensive than we thought it would be, or it's not reasonable to have expected us to have known that it was going to be this amount. So the Act actually requires trustees to do that, to look at each cost center and to go back to owners and advising them where they've overspent. Now, the problem with that is sometimes it's not practical to do it, especially if the amounts are very small. So in terms of, say, your repairs and maintenance plumbing, if you've been mandated as trustees, governing body members, to spend 20,000 and you spend 25,000 or 21,000, that same regulation, or that same onus is on you to go to the owners and saying, you've only allowed us to spend 20 and we spent 21. So in doing that, to go back to the owners for, say, 500 Rand or 200 Rand, can actually become very onerous and can actually become tedious to a degree, because it's such a small amount you've gone over, and yet you're going to have to spend printing stationery, sending out emails, etc. So what we've done is in the minutes of the AGM, and you would have seen in your minutes of the AGM, this is one of the directions given to the owners at the AGM. So it says, trustees may utilize all general funds not already in the maintenance plan to offset a deficit in the operational budget for the current fiscal period for necessary but unforeseen expenditure. So in effect, trustees can use the general fund where a deficit is incurred, and with that mandate, then they don't have to, every time a cost center goes over budget, come back to the owners and saying, okay, we spent 20 Rand too much here, and it was necessary because of ABCD. So this clause has been put in as a direction at the AGM, but obviously this direction can only be useful to have if you actually have a general fund. So if the scheme have a surplus. Okay. The next slide. Okay, so the regulations to the Act state that the trustees are obliged to apply the body corporate funds in accordance with the budgets approved by members at a general meeting. We discussed that. The regulations also say that at a general meeting, one of the agenda items to be considered for approval is the budget for the administrative and reserve fund for the next financial year. And finally, one of the duties of the managing agent is to report to the members of the body corporate how the scheme is administered. Okay, so we get then to the statement of financial position. So this used to be called the balance sheet. It's now called the statement of financial position. In essence, what it's showing you about the scheme is your equity, and equity should equal to your assets less your liabilities. Another way, it's just mathematical equation. If you take the A over and the E and put on that side, assets is equal to your equity plus your liabilities. But the way we've laid out the statement of financial position is we're showing your equity, and then we're saying to show that it balances then is your assets less your liabilities. So let's start with your equity. Right, okay, so the first part in the statement of financial position, which is the section called equity. The very first line, as you can see there, it says net surplus, deficit current for this year. And in this case, we've got 3,289.04. If I just go back to this slide to show you the income and expenditure, the full slide. So United Villas, this is the total income that they had for the year actual. This is the total expenses they had for the year actual. And then they had, this is a total deficit, 8,533. Remember, we had the 11,000 brought in to pay for it, and therefore they've got a surplus of 3,289. Let me see if I can rub that so you can see the amount there. And then I'll just zoom in. Okay, so they have, oops, sorry. That's fine. Okay, so they have a surplus of 3,289.04. This surplus is just for the current year. So that's just if you're comparing the total income for the current year less the total expenses for the current year. This scheme have a current year surplus, because it's not in brackets, of 3,289 Rand 4 cents. So now when we get to the statement of financial position, to the equity section, you can see that's actually the very first line that it starts with. So it's your net surplus or deficit for the current year, 3,289 Rand 04. So that's their current surplus. And then we say prior year's surplus or deficit. So in this case, it was 4,603 Rand 8 cents. And then the balance as of the 1st of March 2013, because that's when we started using our current accounting system. So we have a take-on balance as of that date of 11,780 Rand 93, which means this scheme has an overall surplus of 19,678 Rand 5 cents. So that's the surplus. So that means if you were to go back to when the scheme started or was incorporated to date. So if you went back to when the scheme started and you took all of their income less all of their expenses, you've made this scheme have a surplus of 19,678 Rand 5 cents. Now, 99.9% of statements of financial positions that you look at, they just show you this one line. They just show you the line which says general fund accumulated surplus or deficit to date. So they would just show you that. We just thought, well, we can, it's in our system, we know the breakdown. So we can actually say, this is your current year, prior years, and as of the 1st of March 2013, this is what your general fund was. But in essence, the important figure is this 19,678. That's the surplus they have to date. Okay, and then also in the management account, which is quite useful, is we show you on the right-hand side here, you can see it says prior year to date. So this time last year, so at the end of January last year, their surplus was 16,874 Rand 70. So it's showing the same position last year. Where were you? So you can actually see if you were getting better or worse. And then underneath that, then you've got your reserve fund. And in this case, United Villas have a reserve fund balance of 40,018 Rand 78. This time last year, they had 33,409 Rand in their reserve. The reserve fund, if you look in this first column, let me just get a pen back on here. If you look in this first column, which says movement, this movement here, so it's saying from last month to this month, how has this account been affected? So in this case, it's gone up by 1,544 Rand 46 cents. What is that made up of? So if you remember in our income and expenditure sheet, I've just put a snip here at the bottom. We had the expense, which the reserve fund interest as an expense, and then we had reserve fund provision. So the reserve fund interest, remember I was explaining that the reserve fund interest needs to be put into the reserve account. in order to comply with the Sectional Title Schemes Management Act. So there is the expense here. So it's coming in as an expense. The contra to this expense is it coming into the balance sheet here, falling into this movement here. Together, so into the reserve account, we not only put this 276.46 Rand, we also put the amount that the scheme budgeted to put in. So in this case, this scheme had a budget or monthly budget provision of 1,268 Rand to go into the reserve. So altogether, the total going into the reserve account for the scheme is the interest of 276.46 plus the 1,268. If you add that together, you get 1,544.46 Rand. So that's the movement. That's where it came from. It was the interest earned plus the amount that they budgeted to put into their reserve. And remember, if in that month, like they had in August, if you had any reserve fund expenditure, then it would have, the movement may be negative. You may have less of a reserve fund, because whilst you're putting in the 200 Rand interest and the 1,200 Rand provision, if you've spent more than that, then your movement will be negative. Okay, so in terms of this scheme then, in terms of United Villas, we've got the general fund, which we said was the surplus that they've built up from the time that they started, together with the reserve fund provision. Now, the Act does not state what the general fund should be considered. It does not say that the general fund is the same as reserves. It doesn't say that the schemes need to treat a general fund the same as reserves. And in technically, a scheme shouldn't have a general fund, because in terms of if in a perfect world, whatever you plan on, whatever you raise, you're spending. And so at the end of the year, if you spent what you've raised, you wouldn't have a general fund. You wouldn't have made a profit. And schemes are not for profit. So a general fund, in essence, is actually silent in the Act, because one shouldn't be aiming to have a general fund. But you should be aiming to have a reserve fund. So the Act gives a lot of legislation around this, around your reserves. When can trustees use it? What can it be used for? What do you have to notify owners, or when do you have to notify owners when you're going to use it? All of that is legislated with regards to what's in your reserve, but what's in your general fund isn't. So we often get questions like, when schemes are putting in water meters, can we use, do we have enough funds to put in water meters? Can we use our reserve fund for water meters? No, water meters is an improvement. You can't use your reserve, but you could use your general fund if it has not already been earmarked for your 10-year maintenance plan. So when we're drawing up your 10-year maintenance plan, we do look and see how much do you have in reserves, and we also look and see how much do we have in your general fund. So if that general fund is required for that 10-year maintenance plan, or in order for the scheme to meet their 10-year maintenance plan, then you couldn't use it. But if it's not been earmarked for the 10-year maintenance plan, then those are the funds that you would be using in that scenario. Okay, great. Okay. The next section then is assets. So remember from the beginning here in our statement of financial position, we said we've got your equity, which is equal to assets less liabilities. So now we're looking at your assets section in the statement of financial position. Okay, so the assets section, you've got your cash and cash equivalents. So in this case here, you've got all your bank accounts. Some schemes have more than just 2 bank accounts. United Villas have 2. In the first account, they've got 11,147, and in their investment account, they've got 57,713. So the total cash in hand they've got is 68,000. Current assets don't necessarily only need to include your bank account. Some schemes will have petty cash in there. Some schemes will have actual assets which they've noted and are depreciating, like say CCTV installations, things like that. So you'll have your assets there, and then here you've got a section which says trade debtors. In this case, United Villas have a trade debtor of 5,446 rand 33 cents. The trade debtors is basically your total debtors from your age analysis from your owners. So if you look at the bottom right-hand corner here, I've got an extract of an age analysis. It shows how much each owner is currently owes, or if they've paid in advance, it'll show as a credit. So unit 1 has paid in advance. If they're in arrears, it shows as a debit. There's no brackets there. So unit 2 in this scenario owes 398 rand 15. Unit 3 is in credit of 1,533. Unit 4, they're in slight credit. Unit 5 is in a slight credit. So if you add up all these credits and debits, you get a total for the scheme as a credit in this case. So more owners have paid in advance than are in arrears, of 5,446 rand 35. And then that figure is plugged in or comes through to your trade data section over here. So the reason it's a credit, it means it's a negative asset. So it actually means it's a liability. So remember, if an owner's paid for levies in advance, those levies can't be considered as levies received yet, because if we're in October, say we're in August now, and an owner pays for September, the scheme can't use that September money. It's not money that they can claim yet. So that is a credit, and therefore it's a negative asset. It's a liability in effect. It's not the scheme's money, but the scheme are holding it. So in this case, it's a good thing because owners therefore have paid in advance and the scheme have good cash flow. But in terms of accounting, the scheme has money that they can't use. The scheme has money which is not theirs. So that's why it's a negative asset. That's why it's showing as a, in brackets, as a negative asset. But it's a good thing. Okay, so that's the asset section, trade debtors, your bank account balances. And then finally, you've got your current liabilities. So let's just go back here so you can see the picture of where we're at. So we had your equity, and then we said equity was equal to assets. Here they are, less your liabilities. So if we go down now to the liability section. Sorry, I went too far. Okay, so under your liabilities then, you've got your sundry creditors, you've got your provisions, so any provisions that the scheme have made, so auditor provisions, workman's comp, the provisions and accruals that I spoke to you earlier about, so those will be in that section. Any sundry creditors will be in this section, and then the total liabilities for the scheme. So this scheme owe 3,718 rand 27. So one thing looking at these accounts is it's not very descriptive to say, what are these sundry creditors? What are these accruals that have been made? So the statement of financial position groups them all together and just gives you a total of all your sundry creditors and gives you a total of all your accruals, just as a total sum. But if you want to get more detail as to what are these accruals and what are these creditors, you go to the trial balance, which is the next page in your management account pack. So if we go down to the trial balance, you'll see in the section there, maybe I just need to zoom in a bit. I don't know if you can see this top right-hand corner. In the section, you can see under liabilities, you can see it says accounting fee, 836. So that's one of the accruals that we were telling you, the provisions we were making. Audit fees, there's the provisions that we were making. You've got clearance costs of 1,175. You've got Bellboy disbursements of 8 rand 28, still waiting to be paid, and CSOS. In terms of CSOS, we pay CSOS every quarter. So you'll see a liability building up for 3 months, and then the payment is made. A liability will build up for 3 months. Every quarter, we pay over to CSOS. So that total liability is there, 371827. Going back then to your statement of financial position, 371827. So to get more information of what's included here, go to your trial balance, and in your trial balance, each item is listed with its own description and its own heading to say, you've got accounting fee liabilities, you've got audit fee liabilities, you've got Bellboy disbursements, whatever it is, you'll see the description here. So go to the trial balance to see that description. Okay, I'm just very conscious of time. Okay. The trial balance is an exact repeat of exactly what we've gone through already. So the trial balance, as you can see here, income, total income, there's that total income that the scheme had made, expenses, there's the total expenses, there's your profit that the scheme had made for this year to date. So the trial balance is just a repeat of the income and expenditure. So you're combining your income and expenditure, your statement of financial position, you're putting them together and seeing if it balances. So there we have the income, expenditure, there's your profit, you've got your capital and reserves, your bank accounts, all listed, you've got your assets, less your liabilities, which come through here onto the next page, and then you've got your zero balance showing that your trial balance is balancing. So the trial balance, all it is a repeat exactly of what we've looked at with the income and expenditure and the balance sheet and the statement of financial position. Okay. Cash movement report. This report basically, it's a standard report that's required with management accounts, but it groups all the payments made out of your bank account, it groups them into into different sections. So how much was for bank fees, how much was for insurance, etc. One thing you can check as a trustee is if you look at the end of your cash movement report, that closing balance should be the same balance noted as your bank balance. And when you look at your bank statement, that should also be your closing balance in your bank statement. Okay, the other thing that Bellboy provide in your management packs is we give you the actual bank statement. We also give you a bank reconciliation statement, which I've just marked here with the star. So the bank statement, you can see the balance here. That balance should be the same as on your bank reconciliation statement, and that shows if that is the computerized, the balance as per the bank statement, and this is the computer generated bank balance, we've captured everything from your bank statement has been captured. So the reconciliation shows as nil, which means we've captured everything correctly. One thing I just wanted to mention, we also include this report here. It says F&B payments transactions run report. This report is an F&B report. Bellboy are on F&B host to host, which is a secure link to the F&B servers. So what we do is we have a specific program that enables us to put files onto the F&B server. F&B take those files and bulk process them to make payments and to do debit order collections, etc. As far as I'm aware, we're the only managing agents in the Eastern Cape who are on F&B's host-to-host system. What it does is it does enable, because it's a bulk submission, we do have we get the schemes benefit from very low rates with regards to payments and with regards to collections. So as an example, if a payment is made as a once-off payment, F&B would usually charge R8.75, but through the bulk submission service, they charge R2.35. And with regards to debit orders, if one is to do debit orders through online banking, it's R16.75 for 75 cents for it's per debit order. And yet through bulk submission, it's R2.35. So the benefit to the schemes is much lower bank charges because of the fact that we're on F&B's host-to-host system. But what that does mean is because we're submitting on this bulk system, we submit a single file onto the F&B server, and F&B almost instantly takes that file and sees, okay, this contractor needs to be paid from that account, or this contractor needs to be paid from this account. And it processes that and it gives us a report back and it says, okay, these are the transactions which were successful, these were not. So this F&B transactions report, in your bank statement, you will see a line and it just says Bellboy Contra or BB Contra, like here. And that's because it's a Bellboy link. It's a single server. We're putting a single file for all of the schemes that we manage, and F&B are then taking it and making payments from each of individuals' bank accounts to suppliers. So it's not a bulk, it's not a single bank account, but FNB was giving FNB a single file to process from those bank accounts. So on the bank statement, it just says Bellboy Contra. So it's very difficult to see what was that payment made for. So FNB then give a report, which is called the FNB Payments Transactions Report. And you can see then it'll say it was for the, in this case, it was the municipality, how much it was for, and the account or the bank account details that it was paid to. So this transactions report needs to be read in conjunction with the bank statement for any entries which were made on FNB's host-to-host system. Okay, great. And then the next slide then. So then we have your investment account. So this is exactly the same. You've got your, we give you your actual bank statement from FNB showing your bank balance. We give you then a bank reconciliation statement, which then shows that we've captured all those line items which are in your investment account. And then it says there's a difference of nil, which means everything has been captured. And if you have more than one investment account, again, that will be repeated. It will be 7-day account. It will give you your statement and then a bank reconciliation, and then we'll give you your 32-day if you've got one, and your bank reconciliation for that account. Okay, and then the next document in your management account is your age analysis, which I've already gone through with you. Showing your final balance. Just to note that your property portfolio managers will split this when they're doing the minutes for your trustees meeting. So the property portfolio managers will tell you what is your total RAND value for owners in arrears and what's your total RAND value for owners in credit. So, from a trustee's perspective, you will be told that at your meeting, and then it will be minuted as well. Okay, then the last two documents in your management accounts is you've got a invoice, a Bellboy invoice, and then a recoverable or third-party invoice. The Bellboy invoice is basically just for Bellboy costs, which is, say, the management charge, processing fees, things like that will appear on the Bellboy invoice. And then a recoverable or third-party invoice. So this invoice, if you look at the note at the bottom of the invoice, it says, recoverables. This is recoverable charges are incurred by owners and recovered from the scheme, e.g. debt collection. So debt collection is charged to the owner. If the owner pays those debt collection charges, then it will be collected through this third-party invoice. And then third-party charges are costs incurred by the scheme and charged in terms of current disbursement schedules, e.g. debit order charges are raised where applicable by FNB and are recovered from the scheme. I'll give you another example. We have some schemes use Miclo distribution to collect their black bin bags. So they'll go out, they collect black bin bags, they charge 109 Rand 25 cents plus VAT. That will appear on here. They charge Bellboy, and then we pay them a single amount, and then we charge the schemes 109 Rand 25 cents to recover that charge from them. So everything on the recoverable invoice or third-party invoice is an invoice from a third party which is being charged to the scheme. And your invoices are your last two documents on your management account pack.
Jason, thank you very much. I think that wraps it up for insofar as unpacking the management accounts are concerned. It's been very informative. I'm sure if there were any questions relevant to this, I think there were one or two questions that were raised. Unfortunately, we do not have much time to go through all the questions. But Jason, I'm going to put one or two questions to you. As I said earlier on, any questions that we cannot deal with now, we will respond directly to those questions posted. Jason, just relevant to the first question I want to put to you, it says here, why does the 11,822.50 Rand that appears on the income and expenses statement appear twice for November under building maintenance and the reserve fund transfer? You can just go back to that page. Thank you, Jason.
Excellent question. Okay, so in terms of this scheme which does not exist, in this case, there was actually a 50% invoice paid and then the balance paid. it was decided by the trustees that they would only put half of the invoice, or half of it would be paid out of the general fund and the other half would be paid out of reserves. So the part which was not paid out of reserves goes in as a normal expense. I'll just bring in my pen here and try and zoom in again. So this is a normal expense here. And then the part which was being paid out of the reserve fund, which is here, is the one where the money came in back in from the reserves in order to pay for it. So this is actually just unique to the scheme. They felt they did have general funds. If you look at their statement of financial position, they did, obviously this 19,000 is after that has already been expensed in the general fund. So they felt that they had enough in the general fund. They didn't want to put the entire amount through the reserve fund, and therefore they split it. So the 50% deposit that was paid was treated as an expense, and then the final payment of the 11,000 was treated as reserve fund expenditure. So they split it that way.
Okay, great. Thanks for answering that one. Jason, just a last question. And as I said, the rest we will deal with in a direct response to those questions posted, is how do the prepayments come about?
Oh, okay. So generally with sectional title schemes, community schemes, etc., you won't pay in advance, but there are scenarios. For example, some schemes have say an annual insurance policy. So they pay, say, on the 1st of March for the whole year. So rather than just putting it in as an expense in that 1 month, what we do is we put it into a prepayments account, and then we divide it by 12, and each month we will journal out from that annual insurance premium, we will journal out an equal amount until the end of the year when it will be nil. And another example is some schemes will have noticed there was a refund from FNB for bank charges, and FNB had made that refund twice. So that created a prepayment because the refund came through from FNB for an incorrect charge that they had made, but they had refunded the schemes twice. So we would put that to a prepayment account and request obviously FNB to correct that on their side. So that's just 2 examples of why we would have prepayments. But generally, schemes don't go around, paying people in advance. But sometimes it's inevitable that it happens out of our control.
Okay, great. Jason, thank you very much. We're going to close this webinar, but just before we leave, I just want to remind you of our next webinar, a live webinar scheduled for the 27th of August, where Hayden du Preez will be unpacking audited financial statements. And then another one to be hosted on the 3rd of September, where we will be unpacking the budgets for community schemes. Thank you all very much for your attendance at this webinar. Keep well, and we'll see you next time. Thank you. Bye-bye.
Thank you.